It's time for Yahoo Finance's Market Minute. Stocks mostly moving to the downside after closing last week with their longest winning streak in over 20 years. Meantime, shares of media companies under pressure as President Trump calls for a 100% tariff on films produced outside of the U.S. It's not yet clear how a levy like this would be imposed. Many U.S. movies and shows are shot on location and even have editing work done outside of the country. Now, on semiconductor shares reversing earlier gains, they popped 2% in pre-market but are now down a little over 8%. The company topping Wall Street's expectations for first quarter earnings, issuing a better than expected forecast, but those shares still moving to the downside. Meantime, shares of footwear company Skechers surging after announcing it's going private in a $9.4 billion deal with 3G Capital. 3G will pay Skechers shareholders $63 a share in cash. The deal is expected to close in the third quarter of this year. That's your Yahoo Finance Market Minute.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. On today's show, gold prices are rising, helped by a weaker dollar as investors await the Federal Reserve's next policy decision. That comes this week. We discuss 3 gold stocks potentially for your portfolio. And building your savings amid economic uncertainty. We discuss some of the strategies for wealth preservation. Plus, the Department of Education will begin federal student loan collections starting this week. We discuss the implications for your debt. All that and much more coming during today's show. But first, let's begin with a look at the market action. We are 90 minutes into the trading day, and I want to zoom on over to some of the activity that we're seeing in the major averages because I've been tracking some candlesticks here out of the gate here for you. I know what you're thinking, and let me get into those candlesticks in a hot second here. I'm just waiting for this to actually calibrate back over to some of our gainers. We'll approach it from the heat map side, why don't we? Taking a look at the NASDAQ here right now, where you can see that we're having a good mix of gainers and laggards. Seems like just a few more gainers than laggards right now, led by the trade desk, PayPal, and Fortinet also. But then taking a look at the S&P 500 here on the day, and overall, we are down by about 0.3%, but off of today's session lows where we began the activity. And as of right now, taking a look at the sector activity, 11 S&P 500 sectors loaded up here for you on the screen. Pulling up the caboose is energy right now. That's down by about 1.6, 1.7%. Industrials, though, leading the pack here and making its way out of early negative territory to start off the day's activity. Also want to take a look at some of those Dow components for you here. We've got a big week of earnings, and of course, as we continue to move forward, one of those names is going to be notably in focus here, especially with some fresh tariffs that have been threatened or at least teased by President Trump via Truth Social. And Walt Disney Company is that company that's going to have its ears perk up in a big way for Mickey Mouse there. You're taking a look at shares actually down 0.1% here during today's activity off of the session lows. But the entertainment industry is certainly on high alert as that starts to get talked about among the administration members. We'll see what comes to fruition. Switching gears here. Gold prices are rising, up more than 2% today, spurred on by weakness in the U.S. dollar as investors consider the next step in tariff negotiations and the Federal Reserve's policy meeting this week. My next guest is here to address why gold is so appealing right now. Joining me now on set, we've got Chris Mancini, who is the Gabelli Fund's Associate Portfolio Manager of the Gabelli Gold Fund. Great to have you here with us. Just take us into what you've been analyzing in terms of the correlation and the price action that we've seen in gold in the early months in 2025 thus far.
Yeah, I mean, I think what we've seen so far is that the big deal is that we've had gold has, so with gold, the big thing that happened was when Russia's reserves were actually confiscated. And that was the biggest deal. That happened way back in 2021 when Russia attacked Ukraine. But what's happened this year so far is with the tariffs happening, the big situation is that the world's trying to kind of recalibrate whether or not they want to hold dollars, and whether they want dollars to be the global reserve currency. And so as they're assessing other options, and specifically China is assessing options. They're considering what that could be, and gold really is the only other alternative.
So what is the smartest way to play gold in your portfolio right now? Is it holding physical gold? Is it holding gold ETFs or miners of gold? What's your assessment?
Well, we think that owning the miners right now is the best way to do it because the miners are really cheap. So what's happened is that the price of gold's gone from around $2,000 an ounce up to like $3,300 an ounce today. And the miners haven't moved as much as the price of gold. The miners right now are generating lots of free cash flow. They're paying dividends, and more importantly, they're buying back lots of stock because their stocks really are so cheap. So we think that that's the way to do it.
And so with those gold miners in mind here, where and who is the top player, the top pick, if you will, even among the miners that are publicly traded?
So we like Newmont is the biggest publicly traded company right now. It's very cheap. It did a deal with, it acquired Newcrest, which is a big Australian company. It's the biggest gold miner in the world. That deal didn't go as well as they had planned. There were some integration issues. We think that those are mostly behind the company now, and we think that it's buying back lots of stock, and it'll do very well going forward.
Even as we think about the run-up, a lot of investors are going to ask, is it too late to get into the gold trade right now?
Right. I don't think so. I mean, I think what I like to say is that the path of least resistance is up. So specifically really with China right now, China owns, as I was kind of talking about at the beginning with what happened when Russia's reserves were confiscated, China has around $800 billion of US treasuries in foreign currency reserves. And it looked at what happened with China, with Russia. It's seeing what's going on now with the Trump administration and tariffs and saying, you know, do we really want to hold as many dollars as we do? And so that's going to be the trade going forward, is just really having China and the rest of the world really diversify out of dollars and into gold. And China's central bank is buying gold now.
And so as we're thinking about some of the names that you were mentioning a moment ago, what's different about your top pick versus the others that are in the space right now, and the analysis around where they could potentially see some favorability within the market?
Well, I think the big deal with Newmont is that the market doesn't like them because of the deal that they did with Newcrest, and the market's still digesting that deal, and Newmont's taking advantage of that by buying back lots and lots of their stock. So as they're generating all of this free cash flow at these really high prices, they have a very clean balance sheet, and so they're in a position right now. They're also growing production as they're buying back the stock. So in like a year and a half, when their production's higher, they've bought and back all this cheap stock. Then they'll be in a position to raise their dividend and really return capital to shareholders in the form of dividend.
Chris, really great insight analysis. Thanks so much for joining us here in studio.
Okay, thank you so much.
Absolutely. It's now time for some of today's trending tickers. We're checking in on Semiconductor, Wendy's, and Reddit. First up, Semi, falling after reporting first quarter results with a mixed outlook. First quarter revenue and earnings beat analyst estimates. The company's outlook for adjusted gross margin in the second quarter, missing the street's estimates though. KeyBank says that miss is offsetting the street's view on earnings and revenue, with the analysts saying the outlook likely reflects a bottoming and recovery in automotive and industrials. Next up here, Wendy's is getting an upgrade at JP Morgan to overweight from neutral. The firm says that the current share price provides a value-oriented opportunity because they see upside in the next couple of years. Analysts cite solid free cash flow, opportunity for international expansion, and de-risked near-term challenges. The price target set to $15 a share, representing nearly 20% upside for the stock. And finally here, Reddit getting an upgrade at Seaport Research to buy from neutral. The firm citing the company's strong first quarter. The analyst likes that Reddit is one of the biggest websites on the internet and sees user growth climbing. They also cite the potential for ad growth, both in the US and abroad. The firm has a $165 price target on the stock, representing a 45% upside. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Well, coming up, the bull-bear cases for two of the biggest names in energy that are trading in the red over the last year. Stay tuned for that conversation. Warren Buffett says the time has arrived to begin the CEO succession plan for Berkshire Hathaway. The 94-year-old investing legend plans to hand over the position to Berkshire's vice chairman, Greg Abel, at the end of 2025. Buffett has been CEO since 1970 and has been planning the transition for years. In his 2014 annual letter, Buffett outlined the qualities someone would need to be the next CEO. One of them being the ability to make money in excess, but not get greedy and chase bigger paychecks just to keep up with other executives. Buffett famously makes a salary of $100,000 a year at Berkshire, a figure that hasn't changed in over 35 years, according to an SEC filing. He also doesn't take bonuses. To compare, NVIDIA CEO Jensen Huang will make a base salary of $1.5 million in fiscal 2025. But don't get the wrong idea, Buffett is worth billions of dollars due to his share ownership in Berkshire Hathaway. Buffett is the 5th richest person alive, according to the Bloomberg Billionaires Index. He has a net worth of nearly $169 billion, trailing other big tech CEOs like Elon Musk, Mark Zuckerberg, and Jeff Bezos. The majority of Buffett's wealth comes from his 37% stake in Berkshire Hathaway, worth around $167 billion. In 2025 alone, Buffett's net worth has grown by $26.6 billion. That is a significant gain amid recent market volatility that's hit the net worths of many other billionaires. Berkshire Hathaway has outperformed the S&P 500 so far this year, bolstered by the firm's diversified portfolio of owned businesses and equity investments. Energy giants Exxon and Chevron are both in the red over the past year. Both reported quarterly results last week, with Chevron cutting share buybacks amid a broader pullback in oil prices. Meanwhile, Exxon is sticking with its buyback plan of nearly $5 billion in shares per quarter. We want to break down these two stocks, the challenges facing each, and what you should do with them if you're an investor. Here with us now, we've got Stuart Glickman, CFRA Research Energy Equity Analyst and Deputy Research Director. Great to have you on with us today. Let's perhaps start with Chevron, Stuart. Why is the stock in the red, and what is the bull-bear case here?
Hi, Brad. Thanks for having me. So I think the bull case for Chevron, they have some nice assets in the deepwater Gulf of Mexico. They're growing pretty extensively in the Permian Basin, like Exxon is. So both of those things are pluses. The Gulf of Mexico is a longer cycle kind of play, Permian a little more short cycle. So they have a nice balance between the two. Now, for the challenges with Chevron, number one, they have a joint venture in Kazakhstan, Tengiz Chevroil, which has done an expansion, but was very delayed, over budget. That has caused problems. It looks like they're starting to get to the bottom of those problems, but it's been a long time coming. Secondly, their earnings on the upstream have actually trailed those of Exxon, at least in the last quarter. They really didn't do nearly as good a job as Exxon did in the quarter on their operating income per barrel. And third, and probably the most important thing that's an overhang on the stock, you have this legal rock fight over Hess's 30% stake in Guyana, because Chevron has, of course, offered to buy Hess completely. Exxon is saying they have a right of first refusal over that 30% stake in Guyana, and Guyana is absolutely the crown jewel in Hess. So Chevron, if it can't win that court battle, and probably we're going to get to a resolution towards the end of this year, Hess is much less attractive without Guyana in it.
So let's talk about Exxon. Why is it in the red over the past year, and what are the cases for the animal spirits surrounding that stock?
Right. So, Exxon and Chevron and everybody else in the oil space is beholden to what happens with oil prices. So oil prices averaged $77 a barrel for WTI. Today, we're trading at around 57. When we entered the year, I thought that WTI probably would average about $65 a barrel. I've been underweight energy since August of last year. But there are reasons to like Exxon. Exxon has a 45% stake in that Guyana project that Hess owns 30% of. It is far and away one of the biggest contributors to incremental volume growth for Exxon. Even for a company of their size, it actually does move the needle. Exxon has done a better job than Chevron at generating return on invested capital over the years. Their balance sheet is a fortress. Net debt to cap is around 7% right now. Chevron's is pretty good too, but Chevron's around 14%. And Exxon has really kind of shied away from a lot of the renewable energy investments that many other super majors pursued. And I think the proof has been in the pudding. Their returns have been better than companies like a BP, for example, which is struggling.
And so, as there is a Warren Buffett angle with pretty much everything, there is too within this industry, especially thinking about another name that I believe is in your coverage in Occidental Petroleum, while of course Berkshire Hathaway also has some exposure, I believe, to Chevron. As you're kind of evaluating what this CEO transition means, knowing that Abel has his own history as the CEO of the energy division for Berkshire Hathaway, how is this going to be considered as part of their portfolio, and what should investors do with that as they're making the transition at the end of the year?
Right. So I think when Berkshire invested in Oxy, I think they were really approaching it with a very long-term view of where oil prices are likely to go. And I think, to be fair to the energy bulls out there, I do think the longer-term picture for oil is going higher. I think this year is going to be choppy and difficult, but if you're Warren Buffett and you make that investment in Occidental and you get that fairly juicy 8% yield on the preferreds, plus the upside potential from the commons, if oil prices move up, I think this is really a bet on oil over the next 10, 15, 20 years, and not so much what happens in the next year or two. So with that kind of mindset, the lack of investment that many E&Ps have undergone in the last few years will eventually come home to bite. For every dollar of operating cash flow that your random E&P takes in these days, they're spending maybe 45 or 50 cents of that and redeploying that back into the oil field. The other 50 or 55 cents is going to dividends, it's going to buybacks, it's going to debt reduction, all of which are things that don't help, get you ready for the next generation of oil supply that we're going to need to match demand. And I think Warren probably recognized that, and I think the bet on Oxy, admittedly, is aggressive. Given where oil prices are today, I just think it's a question of timing.
Stuart, great to see you, and thanks so much for taking the time here.
Thank you.
Coming up, everyone, simple ways to save money and trim your expenses, including a new way to look at shopping. That's next. According to a recent Gallup poll, Americans' top economic concerns are high cost of living, the cost of their home, and not earning or saving enough money. My next guest has several ways consumers can find ways to save despite economic uncertainty. I want to bring in Lawrence Sprung, who is the Midland Financial founder and author of Financial Planning Made Personal, to talk through some of the ways consumers can save as part of our saving series brought to you by Synchrony. Great to have you back in studio with us, Larry. Let's just start with the basics. How can people build an emergency fund?
I think it's so important to start building that emergency fund, and I think one of the best ways to do it is automate it. The things that we automate get done. So whether that's taking money directly out of your paycheck into a separate account or moving money from one account to another, super impactful. Naming those accounts are just as important too. Name it an emergency fund, and you're less likely to dip into it unless it's an emergency.
How and why should you be automating your savings? That's something that you alluded to just a moment ago.
Yeah, well, think about it from the retailer side, right? Everybody loves subscriptions because we sign up for them we forget about them, and we hardly ever cancel them, right? So do the same thing with your savings. If you automate it, you kind of forget about it. You start building up that savings, and you're now helping yourself instead of on the expense side of the equation.
Well, I need one of my subscriptions to trick me and just say they've been putting it into account the whole time that I can activate a little bit later on. As you're thinking about monthly expenses, how do you know where you can make some of those strategic cuts?
Well, I think the important thing is first go through your expenses overall. Look at them. Are there things you're not using, like these subscriptions? Get rid of them. Get rid of them. Then look at things that are potentially not bringing you any joy, and perhaps eliminate those as well. And then those necessary items where you may be a long-time customer of that company, call them. maybe you can get like an introductory rate as if you were a new customer and reduce your expense significantly. We've successfully done that with cellular phones, alarm companies, cable, etc. It's been very successful in reducing those expenses.
What about debt? If you have debt, why is now a crucial time to pay it down?
Well, interest rates now are significantly higher than where they were, for sure. And more importantly, I mean, credit card debt, there is a difference between good debt and bad debt. Right. I would say credit card debt is the more problematic, higher interest rate. So it's really important that if you want to increase your savings, you've got to cut your expenses. And one easy way to do that is to start paying down those expenses, those debts, so that your interest costs go down and you have more money to save to those other areas you're looking to save for.
Is there an easier method to try and deploy? We know about the snowball, the avalanche methods. Which one do you see most commonly tapped?
The one that you're going to do. The one that you're going to use and use on a regular basis is the one. Just figure out a way that works for you. Are there pros and cons to each of those methods you just mentioned? Absolutely. But at the end of the day, if one, the better one for you is you're not going to follow, it doesn't make sense. Follow the one that you're going to be able to execute on and continue with.
How can consumers practice mindful spending here? This is something that, especially as they're looking across economic prospects, whether that be employment or whether that just be going through their own expenses and pulling back, that they'll start to deploy and they'll start to put into action as well. What is mindful spending on aggregate?
So, I mean, we're always inundated with things that we could potentially purchase, and sometimes those might be good, sometimes maybe not so. So at the end of the day, you have to look at the mindfulness of the spending, look at that potential purchase, and perhaps take 24 to 48 hours before you actually pull the trigger on making that purchase and see if it's something you still want to buy.
And so as you're thinking about some of the different generations and what we've typically been able to do to monitor our own spending, how are tools today different than those of years past, perhaps when we were balancing a checkbook or having a different type of ledger versus the technology that's available to make sure that you're keeping on track with these goals?
I think that the tools are very similar. We've just gone from more of a pen and paper methodology to more of an electronic methodology, and it's just something that you have to do, keep track of, and make sure that you're staying on top of, so you're staying within the confines of your budget.
Mm-hmm. Great to have you here with us in studio, Larry. Great to see you once again. Great
Thanks,
advice.
Brad.
Absolutely. Switching gears here, roughly 5 million student loan borrowers who haven't paid their loans in over 270 days are officially now in collections. Joining us now to break down what it means is Yahoo Finance senior reporter Jordan Weissman. Jordan, what do we need to know about this?
So this is the first time that the government is going to start collecting student loans from people who've been in default involuntarily in about 5 years since the COVID pause back in 2020. Two things you really need to know about if you happen to be in that situation. I don't know how many of our viewers have defaulted student loans. My guess is not too many. However, the government can start garnishing your benefits like Social Security. And later on, it can also start garnishing your paycheck. It has vast legal powers to collect on defaulted loans. The big concern at the moment is that some people might not realize they still have student loans that are in default. There's a lot of confusion among this group of about 5.3 million borrowers who aren't necessarily that on top of their finances. And some of them appear to be under the impression that their loans may have been forgiven in all of the sort of chaos of the last few years where Biden was trying to do mass forgiveness and that got held up in court. So I guess the two things to be aware of, A, make sure you're on top of your debt, and B, be aware that the government can come and collect.
And Jordan, you identified a few changes Republicans in Congress are making right now for student loans. What are those anticipated to be?
So this is a big, slightly undercovered story with everything going on in Washington right now. But as part of the very large, sweeping reconciliation bill, the budget and tax bill that Republicans are putting together, they are thinking of making some major changes to the student loan program. One of the biggies is that you are going to potentially see lower loan limits, especially for graduate and professional school students. That could mean that would be, or that could mean that, people getting their law degree or their medical degree could be pushed towards borrowing private again. That's something we haven't seen much of in the past decade and a half, but we could be seeing the reemergence of, people might need to be going to SoFi or Credible or those other sort of private student loan lenders that are still kicking around.
Jordan, great advice, great breakdown of the news that's knocking around and might not be getting all of the headlines, but worth keeping tabs on. We appreciate it.
Thanks for having me.
Certainly. Coming up, everyone, guess what? We've got much more. We got the tips for building wealth and creating an estate plan to preserve it for generations on. That's next on Wealth. Half of parents with a child over 18 provide them with at least some financial support, according to a report from saving.com. So how can parents of younger kids set them up to be independent and build wealth from an early age? Joining me now on this, we've got the CEO and founder of Hello7, a company that teaches people just how to build a 7-figure business and create generational wealth. Here in studio, she's also the author, we should mention, of Future Millionaire, a young person's step-by-step guide to making wealth inevitable. Rachel Rogers, great to have you here in studio.
Thank you for having me.
Absolutely. So let's dive into this, because as we're thinking about creating that generational wealth, where do parents need to start in teaching some of the early foundations?
Yes. Well, one, you have to, first of all, teach them that wealth is accessible. I think we use that "we can't afford it" language a little too often. So instead, really showing them that wealth is something that they can reach for, and teach them to dream for it, right? And then talk about money in front of them. There was a generation where it was, don't talk about money in front of your kids. Now we need to talk about money in front of them so they know how to make good financial decisions.
Also, part of those decisions are what to spend on, how much to spend on it, and how you are getting perhaps a return on that spend as well. And that puts a lot of families in this conversation, especially when they're thinking about higher education and college.
Yes.
What are the steps that they should be thinking about even as they make one of those larger family financial decisions?
Yes, so I think college is no longer compulsory. I think we have to think about it as an intentional plan, what is this stepping stone and how we're gonna do it? So I think there are two key things that families have to plan for their kids to walk away from college from. One is a professional network, and the other one is marketable skills. So, 18th century English lit, listen, I love English lit, but maybe that's not the one, okay? So choosing something where you're leaving with writing skills or accounting skills or something you can sell even as a freelancer, right? So that way even if you graduate during a recession, you're good because you can sell those skills.
And so with that in mind, the keys to building a $1 million career, once you've got the education, you've got the marketable skills as well, how do you take the steps towards building out that $1 million, hopefully more, career?
Yes. Well, first of all, that network that I mentioned is incredibly important because so many of jobs, 80% of jobs are not advertised. So making sure you're working that network and having informational interviews is key. And then the second thing is making sure that you understand that looking for a job is a job. People think sending a couple resumes is going to do it. That ain't it, okay? You've got to send cover letters, resumes, and be very, very intentional about finding that job. And then once you get an opportunity, make sure you negotiate. 87% of young professionals that ask for more in their initial salary conversations get it. But 60% of them do not ask. So you've got to ask, and that literally, immediately, you get a jump start on your wealth building journey because now your salary floor is higher than it could have been.
What are some of the successful early steps you see people who are just getting into their career? We have a lot of new college graduates that are going to be crossing the stage and pulling the tassel to the other side, who are in a couple weeks going to try and figure out how to navigate an environment where there are hiring freezes that are being put in place, where they're still going to have to try and use that network, but at the same time, positions are going to be harder to come by as well.
Yes, so I think it's very important that they see the job as a stepping stone. It is not the whole story. It used to be the whole story, it's not anymore. So now, how can you use some of the money from that job and start a side hustle so you have a second revenue stream? Could be a fun hobby kind of thing that brings in extra money, and then you use some of that extra money both to enjoy some of the pleasures of life, like to pay for those vacations, and also to invest so that you can start to separate your labor from your earnings, right? And start building on that journey. So I think that's how the approach has to be. The job is not the end all, it's the beginning of your wealth building journey, and you need these other pieces, the side hustle and investing, to fully realize the quote unquote American dream these days.
You started to touch on the last point that I wanted to discuss with you, growing the money once you start making it.
Yes.
And how you can kind of scale that over time.
Yes. Yes, so you've got to start becoming an owner, right? Either owning stocks, owning a business. 50% of Americans are not investing because they say they don't have enough. And why do they not have enough? Because they're relying on jobs that are not keeping up with inflation. So having the side hustle to give you that extra sum of money that you can then invest long term, that's the play.
And so, how risky should they be early on?
Index funds all the way. Keep it very boring. Like invest and forget about it. You know what I mean? And don't touch it. So no matter what's going up and down, listen, leave it right where it is and let it watch it grow and then put as much as you can in there consistently.
Rachel, great to have you here in studio with us. Appreciate it.
Thank you so much for having me.
Absolutely. Well, switching gears here, the great wealth transfer. We'll see $84 trillion change hands from baby boomers to millennials and Gen X by 2045. That's according to Cerulli Associates. With this massive movement of assets taking place, our next guest has identified a potential choke point that he calls the great wealth gridlock. With 93% of clients expecting estate planning from their financial advisors, 22% receive it, according to McKinsey. So how do we fix this service gap? Joining us now, we've got Dominic D'Andrea, who is the D'Andrea Wealth Management Financial Advisor. Great to have you here with us. Let's break this down because we often kind of talk about this great wealth transfer and say, oh, it's going to be amazing, and really tracking some of the different types of investment theses that come forward. The number of women that are going to be able to take on even more wealth as well as part of this transfer. Let's just take a step back. What are the first 3 steps that should really be thought about when it comes to estate planning as part of this great wealth transfer?
Well, first, you have to realize you have a problem. And you have to sit down and realize, what are your assets, what are your debts, what do you need to transfer to the next generation, even if it's your spouse, because there's ways of doing it that can go in better ways from the spouse to your children or whoever you want it to leave.
And so in that planning process, what are the conversations that families need to be having as well?
Well, it starts with somebody guiding them. Like when I sit down with a client and I'm looking at the situation, I can see they're going to have a problem. And knowing that they're going to have a problem, I'm going to guide them. I'm like, look, do you have an estate attorney? If they don't have an estate attorney, or if it's a simple problem, we use a software program, wealth.com, which I can help facilitate an estate plan for them in a simpler process. If it's more elaborate, I'm going to recommend they go to an estate attorney, which I have a few that I recommend. I recommend anybody that's in this industry to have a deck of people that they can recommend, because most investors and people in the general public, they don't know who to trust. They don't know where to go. So I try to make sure I have assets and partnerships that I can be their quarterback in their financial plan and give them these people that I can recommend comfortably.
Okay, so naturally, as you're starting to work with a professional, there are going to be some documents that you need. What are the top documents that you should have lined up, ready to go?
When they're sitting down, well, anything investment-wise, all your investments, life insurance, who your beneficiaries, your Social Security information, anything that you're going to need that you think you're going to transfer. If there's charities you care about, because the more you can come prepared to a meeting with, the better the documents are going to be that you're going to be leaving to your friends and family and charities.
How early, what age should people really start to think about estate planning?
Earlier than most people think. Once you have children, you should start thinking about estate planning. Because when you have children, the biggest fight in a family is who's going to get your children. So you have an idea who you want, but some family might say, oh, I should get the kids. You don't want, so you need to have it starting with your babies, because you want to know who's going to get your children. You want to have the discussion. And then it's something that should be reviewed on a regular basis, because as you're getting older, you want to make sure your healthcare proxies are in place.
Right.
Because you never know when that time's going to happen. I mean, my mother passed away in her mid-50s. We didn't have those documents in place because I didn't think my mother was going to pass away in her mid-50s. So you need to have them in place so somebody can respect what you want your decision to be.
Absolutely.
And life changes. In your 50s, you probably want to have every necessary means to save your life. Right. If you're in the 80s, you might say, I lived a great life, I'm good, let me please go. So always review your documents with your professional, at least on a few-year basis.
And so what do the wealth recipients then, the family members and those who are beneficiaries who you're working with, also need to make sure they do to retain what is put in that estate planning for themselves?
Great question. Well, first of all, if it's a properly laid out plan, they're not going to have too many decisions. If it's a trust, it's going to lay out how the people are going to get the money. Like I said, when you talk about ages, if you got younger children that are inheriting the money, obviously you're going to put some guardrails on how they're going to get the money, especially if it's a substantial amount. If it's older people, you might use a charitable remainder trust where you can have tax benefits for the beneficiaries. So each one of these areas are going to depend on what life cycle the person's in, and where they want to leave the money and who they want to leave it to. And again, that's why you constantly want to review it, because if you have a properly laid out income distribution plan in retirement, your odds are going to be leaving even more money potentially. So again, that's why you want to have the properly laid out plan, which again, if you're working with somebody, they should be able to help you with that. And most people are expecting us as financial advisors to give them that kind of guidance.
Dominic, thanks so much for joining us once again here in studio. Great to see
Fantastic.
you.
Thank you for having me.
Absolutely. Everyone, we've got much more on wealth coming up after the break. Stick around. You're watching Yahoo Finance. Planning a big summer getaway? Make sure you've got the right ID to travel. Starting May 7th, every air traveler over the age of 18 will need a real ID to pass through security checkpoints. Yeah, I know what you're asking. What the heck is a real ID? Well, a real ID is a federally compliant DMV-issued driver's license, learner's permit, or state ID required for all domestic flights. A real ID compliant license has a star symbol in the upper right corner. Now, if you're not sure if your license or ID qualifies, check with your state's DMV. If it does not, you'll need to get a new one, and it could take weeks for the hard copy to arrive. The Department of Homeland Security warns that paper or temporary IDs may not be accepted by the TSA, so make sure your identification is in order before you travel. If your driver's license isn't real ID compliant, don't panic. Other accepted forms of ID include a passport, a permanent resident card, an enhanced driver's license, or a border crossing card. For a full list of acceptable IDs, head to the TSA website. And travelers who don't have a real ID or another approved form of identification, they may face delays, additional screening, or may not be allowed through security at all. Picking a partner is one of the most consequential decisions you can make in your financial future. But nearly a third of Americans are uncomfortable discussing money in their relationship, according to a recent survey from Talker Research. Joining me now to talk all things finances and relationships, we've got Patty Asai, a finance expert with more than 1 million followers on TikTok. She's also the author of a new book, Never Date a Broke Dude, The Financial Freedom Playbook. Patty, great to have you here in studio.
Thank you for having me.
Okay, so as we think about this, I gotta ask you, how do you define a broke dude? We should just get that out the way.
Yeah, I'm so glad you asked that, because being a broke dude has very little to do with your bank account. It's someone who, regardless of gender, can't match your ambition, drive, commitment, or work ethic, right? You want someone that matches your energy. You can't be hustling and the person sitting on the sofa eating Cheetos. And I always say, you don't have to match me dollar for dollar, but you do have to match me hustle for hustle. So that's what's important.
And so when it comes to relationship red flags, what should people be on the lookout for?
All right, I'm going to give you 3. Okay. The first one is if they ask to borrow money. That tells you that they're not good with money because they're asking to borrow money, and that they've run through all their friends, all their families, and haven't paid them back, and now that they're asking you to borrow money. That's a huge red flag. The next one is the person that's always in between jobs, can't get a job, can't find a job, don't have a job. They don't want a job, all right? And that person is not going to change. And lastly, if a person doesn't want you to earn your own income or insists on merging accounts, that means that they're trying to control you with your finances, and that's a huge red flag.
There are plenty of stereotypes and expectations around dating, namely that a man should pay for everything. That's one of the most popular. You say that that's outdated. Explain more on that.
That is so outdated, because what women don't understand is that notion came from the patriarchy. The patriarchy created that because women couldn't work, we couldn't have their own bank accounts, so we were dependent on men for our finances, and that was a means of control. So today, if a woman expects a man to pay for everything, she has to understand that in exchange for that money, she's giving up her power and control over her own life. So each people, they should be financially independent, and they should contribute to the finances of the relationship.
And so as you're starting that contribution together, what are some of the early steps for the conversations about merging finances, about making sure that for all the goals that you've collectively set together, that you're hitting those in stride?
Sure, I put 7 in the book, but I'll just give you a few.
Sure.
So the first one is you want to make sure that your financial goals align. Maybe you want to buy a house and build investments, and the other person wants to live in an apartment and they're happy that way. Your financial goals have to align. You have to know, are you a saver? Are you a spender? What are your money habits like? You also have to know what their credit score is. because you can't even rent an apartment without a good credit score, right? I mean, it's crazy what their debt to income ratio is, how much money they make, whether you have to support other people later on in life, like maybe you want to support your parents and the other person's like, no, well, I don't want that. So those are all the conversations that you need to have before you say I do, because by that time it's too late.
And so as you're thinking about people who've successfully picked right partnerships and had those conversations and made sure that they are charting that path forward together, where have you seen them continuously have check-ins over time as well? And how important are those check-ins?
Those check-ins are huge, and you really need to have a check-in every 6 months. You need to sit down, put it on the calendar, because if you don't, you're not going to remember. Every 6 months, you're going to sit down and you're going to talk about your financial goals. Are we there yet? What can we do to get there? Are you frustrated about something? Am I frustrated about something? Get those out on the table, because that's going to help you in the long run.
Just lastly, while we have you here, how do you understand perhaps the changes that need to be made when your financial priorities change as well over time? Say you're starting a family, or say you're looking to own a home in the future.
Right. So you need to sit down and figure out how much money you need in the future and what budgeting you need to do now. Because if you just have a child, it's so expensive. And if you're not ready for it financially, it's a huge strain on the relationship. So anytime there's things that are upcoming, sit down, talk about it, and make sure that you're on the same page.
Patty, thanks so much for taking the time here with us in studio. Really appreciate it.
Thank you for
Congrats on the book, too.
Thank you. Very excited.
Never Date a Broke Dude, available for pre-order now. Well, Treasury Secretary Scott Bessent delivering remarks at the Milken Institute Global Conference in Beverly Hills this morning. Bessent touting the U.S. as a, quote, premier destination for global investment.
Tariffs are engineered to encourage companies like yours to invest directly in the United States. Hire your workers here, build your factories here, make your products here. You'll be glad you did, not only because we have the most productive workforce in the world, but because we will soon have the most favorable tax and regulatory environment as well.
Secretary Bessent also looking to seemingly ease fears around tariff uncertainty, saying that China is the biggest piece of the trade puzzle. And with all other nations, there could be a, quote, big, beautiful rebalancing.
We want more manufacturing. Everyone agrees, except Chinese leadership, that they need more consumption. We could actually do that together. And then, look, on the other side, that getting better terms of trade is not always a straight line. It's not always a pleasant process.
President Trump saying over the weekend that there is a possibility for trade negotiations to come this week. Let's take a look at the markets here as we're approaching 12 noon Eastern time. The major averages here are mixed. The Dow has seen a lot of candlestick activity to get it into positive territory, a far cry from the declines that we saw to start today's trading session. The Dow is up 0.2%. The S&P 500, you're seeing that right now lower by about 0.3% here on the day. And as I'm taking a look at some of the sector activity on my screen here, as of right now, things are being led by the industrial sector, real estate. However, there are less gainers than laggards here as energy is pulling up the caboose. Oh yeah, and taking a look at treasuries here on the day, they are higher across the board as of right now. And we also want to check in on Bitcoin to see how BTC is faring on the day. We've moved off of some of those 95,000 psychological markers here and a key technical level as well, we could add. But it's down right now by about 1.9% here. And lastly, we started off the day taking a look at gold here, and gold is still holding above 3,300 right now. That represents a move higher here today of about 2.4%. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.